mathematics from the University of Pennsylvania. He was elected to the prestigious Phi Beta Kappa Honor Society, former full-time professor at Thomas Jefferson University in Philadelphia, Pennsylvania. And his option trading system is totally unique, and it's based on mathematical modeling. Here to present to collect rock steady profits with options, try this, is Mark Sachs. Let's we're having an audio issue, but let's give Mark just a moment to sort that out.
Can you hear me? Can you hear me now?
Yeah, you got it, Doctor.
Okay. All right. Well, listen, everyone. This is Mark from Right Line Trading. I was thanking Rory for the really kind introduction. And what I'm going to be discussing today is our credit spread strategy for really what we've done over the course of the last 5 or 6 months is achieve an 80% win rate. Now, it's a formulaic system, and it just works spectacularly well. These are swing trades that you don't have to babysit, and I'm going to go through exactly how we take these trades. Now, just this quick disclaimer that all signals and trading opportunities that we provide are for our demonstration and educational purposes only. Everyone understands that trading the markets involves substantial risk and that a person can lose a substantial amount of money. As I tell everyone that I mentor or trade with, that you should never trade more money than you can afford to lose. Now, here's the Right Line Trading team. It's getting bigger, and I just wanted to say one thing about like David Weiss and all of us that really discriminates us from, I think, any other company or our trading system is all of us, when we proffer you a trade, we take that trade also with our own money in our live trading account. I take every trade that I recommend in my own account in Thinkorswim. And I know that David Weiss trades his system, the one that he just showed you, live in his trading account. So if the trade is good enough for us to proffer to you, whether it be an options trade that I'm going to show you here, or a futures trade that David Weiss, or actually David Kushner just showed you, it's going to be also taken with our own money. And that is exceedingly rare. Now, as Rory said, and I'm just going to review in 15 seconds, I graduated in the University of Pennsylvania with a degree in applied mathematics. I was inducted into the Phi Beta Kappa Honor Society. I graduated summa cum laude with honors. It was always my goal to go into academics and teaching. I was a full-time professor at Thomas Jefferson University. During my tenure there, I published 15 peer-reviewed articles in top-tier journals. I was a full-time professor. I taught an enormous number of undergraduate and graduate students. I've always had the mindset of a scientist, a teacher, and an academician. I've mentored in the past 13 years close to 30,000 traders, either in small groups or one-on-one. And I've been an invited speaker internationally in many countries, and an invited speaker domestically in many cities. Now, the problem that most traders have is generating consistent income in any market using credit spreads. Now, credit spreads are when you sell options. Now, everyone always talks about how You never buy an option, you sell it. I'm going to show you why that's not correct. But in specific instances, selling options to someone else, and instead of paying a premium, receiving a premium is extremely advantageous. In fact, the markets right now are in that position. And I'm going to show you exactly what we look for when we look to sell options to somebody else. Now, jumping between strategies and then focusing and mastering on any particular one is really an enormous mistake. You want to master what you are focused on, what you feel is most sort of fits your personality, the way you want to trade. But if you jump from strategy to strategy, it's really going to be a problem for you. Now, when it comes to trading options, as far as I'm concerned, I've been trading options since 1997. That's 26 years. There's really only two ways to trade options. You either buy a call or buy a put on a position in certain situations, or you sell the option to someone else to create a credit spread. You look at these iron butterflies and these iron condors and these butterflies and all these other multi-legged strategies. I'm telling you, they are nothing. They're going to do nothing more than derail your overall trading performance. You either want to be a naked trader, which is to buy a call or a put on a position. In certain instances, and in other instances, you want to sell the positions to somebody else. And I'm going to show you exactly when you're going to do one or the other, and you're going to master this. Now, the key is that you have tremendous emotional confidence in what you are doing. And obviously, the key to that is that you're going to get winner after winner. And we've been trading at an 80% clip. And to be perfectly honest with you, we closed out a loser today on Palantir after closing out 4 winners in a row right before it to keep ourselves at that 80% clip. A firm we closed this week, we closed about 3 days ago for an 80% winner. So we're running at that 80%, which is way, way above what we need in order to trade exceedingly profitably. So emotionally, to gain confidence is exceedingly important. You have to trade with consistency. So I'm going to show you the math. It's really very, very simple. You have to win at least 50% of your trades. If you win 80% of your trades, as we're doing here, you're going to make an enormous amount of money. You're going to trade very, very profitably. And the rules that we engage are going to be those that prevent any trade from blowing up. When we take the trade, we already know our maximum loss on the trade, and no matter what happens, we cannot lose more than that. Now, we control, when we take the trade, our risk to reward ratio. And the risk to reward on the trade we lost was so great on Palantir that we really only lost a small amount of money, even though it was the maximal amount of money that we could lose on the trade. I didn't dent our overall performance once, but our win-lose ratio is about 80%. Now, when you trade credit spreads, it's a very simple and forgiving strategy, because all you need to do is take a mild directional view on a stock or ETF. And really what has revolutionized the strategy has been trading sector ETFs. We have just blown it away by taking credit spread trades off of sectors, off of iShares sectors. And we have just run it up on those. But as I said, it's a very forgiving strategy, because if you're bullish, the stock or ETF or index equity like the SPY, the Russell, the Qs, they only have to take a very mildly bullish direction. In fact, they really don't even have to go up a cent from where you entered the trade. So it's very forgiving. And it really is a very limited risk. Obviously, since it's a spread trade, it's also going to have a limited reward, but the reward is going to be nice and juicy based on the way we configure the trades and what we're looking for. Now, the reward is based on what's called our vertical width. I'm going to show you exactly what that is. Now, it's really, I think personally, it's really important to have this tool in your sort of your arsenal of trades. You may be primarily, you want to day trade what David Weiss trades, or David Kushner. These guys, David Weiss is day trading options on stocks. David Kushner is day trading futures. I think an additional strategy that you should have in your toolkit or in your in your backpack is a credit spread option strategy. Now you can profit. You hear this all the time, but it really is absolutely true here, and I'm going to show you. You can profit if the stock increases, decreases, or doesn't move at all. That's what makes it so forgiving. You have a limited loss potential, so you never have to worry about a trade blowing up on you. The most you can lose on the trade, you're going to know when you take the trade. And the strategy is very simple. It's very formulaic. You're going to do the same thing over and over again. The key here is trading the right stock, sector, or ETF, or index equity, like the Qs, the SPY, the Russell, is getting into the appropriate financial instrument. That's what I'm going to help you do. Now, I'm going to give you these trades, give you the stop, give you the targets. You're going to get these alerts. I can't tell you the number of intra-week updates I sent out. I just sent out one today on how to manage our trade that went against us. And although we gave back a little bit of money, the key is we didn't give back much, because the loss we took on the trade was very limited by the vertical width of the trade. Now, the stocks actually have 5 directions. And I think that's very, very important for you to know. A stock can take a strongly bullish direction or a strongly bearish direction. It can also take a mildly bullish direction or a mildly bearish direction. And then a stock can trade sideways. It can trade in consolidation, where there's little movement to the upside and little movement to the downside. Now, when you anticipate how much a stock is going to move and in what direction it's going to move, that's where you consider the strategy you're going to take. If you believe the stock is essentially going to trend sideways, you can make 100% of your potential net credit when you sell a credit spread. If you believe it's going to make a bullish move, but not a strongly bullish move, you're going to sell a bullish credit spread. If you believe it's going to trend down, and when I say trend down, we're talking about it only has to trend down 1 cent below the value of the strike price we sell. And I'm going to show you how to configure the trades. It doesn't have to trade down really much at all for you to retain 100% of the credit that you received on the trade at its outset. Now, if you believe it's going to make a strong move to the upside, you're going to buy a call. Strong move to the downside, you're going to be a put. You're going to trade a put. Now, these are less forgiving because in order to become profitable, if the trade, say, cost you $2, it's got to move $2 above your strike price at options expiration in order to break even. Here, it only has to move 1 penny above your strike in order to keep 100% of your credit. Now, when do you want to be a seller of options? Now, I've heard countless webinars from people saying how the only thing you want to do is sell options. That's all you want to do. You never buy an option. Well, that really, nothing could be further from the truth. There are certain instances where you want to buy a call or you want to buy a put, and certain instances where you want to sell a credit spread. And what it really comes down to is putting yourself in the position of being an auctioneer. Now, when do you want to be a buyer? So you want to be in the audience when they're auctioning off a particular item. And when do you want to be a seller? When do you want to stand at the podium with the gavel and selling off that item to people in the audience who are bidding on it? Now, you want to be a buyer when the cost of the item is cheap, and you want to be a seller when the cost of the item is exceedingly high. You want to stand up on the podium when you're selling that option when it's a really pricey option. Sell it to somebody else and they're going to pay you for the privilege of receiving it. In the other instance, when it's very cheap, you want to be in the audience and pay for the option and keep it because you pay very little. So this really just reinforces what I just said. You want to be sitting in the audience and paying a fee when the option is cheap, and you want to be the seller and the auctioneer collecting a fee when the cost of the option is exceedingly high. Now, when we have a lot of volatility, as I'm going to show you, the value of those options really, really climb. Now, volatility is what inflates the price of an option. When an option has a lot of intrinsic volatility, the value of that option, or the amount of money that you have to pay in order to leverage it, really, really goes up quite a bit. So we're going to look for trades on options in which the underlying can be a stock, as I said, an ETF, an index. It doesn't matter. As long as there's a lot of intrinsic volatility priced into the option, it's going to be exceedingly valuable for us to sell and receive a very, very juicy credit for it. Now, our anticipation that as time passes, something is going to strike that volatility bubble and deflate it. And as volatility leaks out, the value of the options we sell get cheaper and cheaper and cheaper. Now, the perfect scenario is at options expiration, the value of the options that we sold are worth nothing. So essentially, we get to keep all the money that we paid at the time that we created the spread. We got the profit, we get to keep all of it. And it really, really comes down to implied volatility. The cost of an option is low and implied volatility is low. the cost of the option is generally high when implied volatility is high. Now, when you sell a credit spread, time is on your side because time erodes the value of the option. And remember, you sold these options to someone else. And when you want to ultimately have to buy them back, which is an options expiration, you want theta decay or time decay to have completely eroded the value of the option down to nothing. So between theta decay and the value of implied volatility leaking out of the options, the value of the options that we sell are going to collapse. And we're going to be able to buy them back either incredibly cheap, so we get to keep up to 90% of the amount of money that we spent, or when we got the position, or we get to keep 100% because the value of the options has dropped to nothing, and the person who bought them from us winds up holding on to options that are valueless. They're the ones that take the loss, and we're the ones that get to keep the net premium we received when we took the trade. Now, here's a bearish credit spread. And I just want to, this is just a general configured spread. I'm not going to go, because I'm going to go into detail. We're on this particular trade, this is on Abbott Labs, and you can see that in general, it's a downtrending financial instrument. Every time it retraces back, it collapses. Retraces back, it collapses. Retraces back, it collapses. Retraces back. We're going to anticipate another collapse. Now we're going to sell a 98 call, 98 delta call, or I'm sorry, a $98 call, and it's going to be a 50 delta. And we're going to buy a $103 call or the 25 delta, and we're going to receive $207 on every spread that we sell. And we're going to risk on the trade. And this is not a terrifically configured trade. I'm just using an example. We're going to risk $293. And that is right up here in the upper corner. Our maximum reward is 207 per credit spread. Our maximal risk is $293 per credit spread. We're going to look for much better trades. I just wanted to give you this as an example. Now, here's how forgiving it is. Now, remember, we sell the 98 and we buy the $103 spread, or the $103 call. Now, we're going to profit from the trade because now we're anticipating a bearish move. If it sits right at 98, which is the price of the stock when we sold it, we make 100% of our profit. If it moves down just a little bit, 10 cents, we make 100%. If it makes a big bearish move to the downside, we're also going to get to keep 100%, but we only need, this is why it's a forgiving strategy. We only need it to move down just a little bit, and we get to keep all the money we received when we sold the spread. Now, here's where it's doubly forgiving. Remember how I said you can make money whether the stock moves up or down? Let's say it moves against us and the stock actually moves up. Because we got $207 of profit on the trade, if it moves up from 98, if it moves up $2.07, anywhere between 98 and $100.07, we're going to make some profit. We're not going to get to keep 100% of the money we received when we took the trade, but we're going to get to keep some of it. We could keep 95%, depending upon where it is. We can keep 45%, depending upon where the price of the stock closes, but we're going to keep something. We're going to trade in the green if Abbott Labs trades all the way up to 107, exactly the opposite direction that we anticipated. Now, if you buy a call or a put and it trades against you, you're going to wind up taking a full loser. Here, you're only going to take a partial winner. And that's what makes it so incredibly forgiving. You can be wrong and still make money on the trade. Now, you're going to take some of the loss if it trades between 107 and 103. Because our maximum risk that we took was $297. So this is, I put 239 in here. That's actually wrong, but these numbers are right. So if it trades between 100.7 and all the way up to 103, we're going to lose some money, but we're not going to lose 100% of our potential loss. And it has to trade all the way above 103 for us to take a full loser. Now that's $293 with a $207 of potential profit. The trades that I can figure have much better metrics than that. But I just wanted to use this to show you how forgiving a strategy it is. The underlying instrument that we use to trade can actually move against us, and we can still, when we have such a wide berth, that we can still wind up making real good money, 50% of what we potentially could have made, even if the underlying goes against the direction that we anticipate. Now, here's where the pedal hits the metal. And here's where it's incredibly important that when we take a trade, this is called what I call the vertical width of the trade. Now, if you take a vertical width where the potential reward is 33% and the potential risk on the trade is 67%. Now, the full vertical width can be $1, but you're going to look to make 33 cents and risk 67 cents on every trade. Now, that's a very terrible, poorly configured trade. So you must win 67% of your trades to trade at break even. You get 2 winners and 1 loser. That's exactly 67%. 2 winners, 1 loser, 2 winners, 1 loser, 67%, you trade flat. Except for commissions, you've lost or gained no money. So based on the vertical width and the risk to reward ratio, it tells you exactly what you need to trade in order to trade profitably. Now we're going to look for trades like this, where the vertical width is between 41 and 45%. Now, the last trade we took a loser on, our vertical width was 45%. So we only lost 55 cents for every dollar we traded. Now, when you trade with a vertical width of 45%, you only have to win 55% of your trades to break even. If you trade with a vertical width of 40%, you only have to trade and get 60% winners. Now, if you do get 60% winners, you make $2, you lose $1.50. You make $2, you lose $1.50. As you continue on, you make 50 cents on every trade. The trade becomes consistently profitable over the course of time. You know, we're throwing away that false narrative where you're going to make 625% on a trade overnight. We're going to trade realistically because I'm trading with my own money in my live account in Thinkorswim. What I want to do, if I can make 100 to 200% per year on the amount of money that I trade in my account, I'm going to be ecstatic. We're closing it on the end of 2023, and I'm up an enormous amount of money. And the reason I am is because I'm not looking to hit that grand slam home run that you see these gurus throw up there. I can guarantee you they don't trade them live with their own money, but what we do is we tilt all the metrics in our direction so that we gain consistent profit, we grow our account, and then at the end of 12 months, when we look at it, it puts a big smile on our face. Now, here's a trade that I took, is on McEwen Mining. Now, it had a $1 width with a vertical width of 45%. We stood to make a maximum of 45 bucks on a risk of $55. That's an outstandingly configured trade. We only need to win 55% of trades configured this way. Now, we sold the $7 put since this is bullish. Now, if the stock closed the 42 days that we use to trade which is the time we use to trade for most of our positions, if it traded up 1 penny above $7, we make 100% of what we received on the trade. But we had a lot of leeway. It could have traded all the way down to $6.55 and still made some money on the trade. It had to trade below $6.55 for us to lose that $55 on the spread. And on McEwen Mining, 55 bucks or a 55-cent move on a $7 stock is a huge percentage move against us. In this particular trade, we happen to get a 100% winner. This actually closed way above $8. It made a much more strongly bullish move than I anticipated. But we took a trade when precious metals made a big, strong run. I was anticipating a mildly bullish direction, and we got a real strongly bullish direction, and we kept 100% of our credit. Now, you're going to get these bullish entries all the time, and this is just an example of a sector trade on the iShares communication. This is the spiders. I like to trade the iShares, and this is iShares communications, or these are the spider communications. It's XLC is the one that I trade. Every time the trade retraced to the 15 period EMA, we went long. 15 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 EMA. This is why our sector trades are so powerful, because the sectors are very trendy. I mean, the XLC and XLK, XLC is communications, and that contains Facebook, that contains Alphabet, Google, and then there's tech, XLK. These are bullish sectors. They've been running long almost all year. But then when they change trajectory, we start taking a bearish position. We start selling calls, and I'll show you exactly how to do it. Every time there's a retracement back to the 15, we sell a call. We sell a call spread. Moves down. Retracement to the 15, we sell a call spread. Back to the 15, we sell a call spread. You see, when this changed direction, we may have taken that one loser. But on the way up, we've took 7 or 8 winners in a row. Ultimately, the market's going to get overbought. We're going to start to stand aside after a while to try to avoid this change in trajectory. But once it starts its move to the downside, every pullback we're going to leverage with an anticipated move back to the downside, and we're going to continue to trade these over and over again. Now, in general, I'm going to take a trade with 45 days to expiration. Now, since we take these every week, you're going to have spreads that are expiring every week. So you're going to have a payday on a weekly basis. And here's the entire formula. I never, when I trade options, I never trade a black box system. Never going to, give you a trade and not tell you exactly how I arrived at the trade. It's going to come with a very, very detailed explanation, both on a fundamental and technical basis, as to why we're taking this trade. And it really takes me a lot longer. It takes me a long time to find the trade, and then it takes a lot of time to write it up. Now, if we're taking a, just want to see if this is bullish or bearish. Okay, well, we're going to sell the at the money always. So we're going to sell the 50 delta, and we're always going to buy the 25 delta call. Now, if we're bullish, we're going to sell the 50 delta put, and we're going to buy the 25 delta put. If we're bearish, we're going to sell the 50 delta call, and we're going to buy the 25 delta call. It's that simple. Now, I put down here to collect at least 1/3 of the vertical width. We know we're going to look for 40 to 45% of the vertical width, because that defines for us what win percentage is required for us to trade profitably. We already know right up front the number or percentage of trades we need to get in order to trade in the green. Now, I just put this up to show that, we have a scanner. Now, the scanner that I use is not part of our platform, but I'm going to show you how you can get it for free. It really is quite powerful and helpful. Although the scanner kind of helps me, but normally I don't really take trades off of it. But it's really good to have. But you see the trade on UPS, it tells you right here, it gives you a vertical width of 41%. You're going to take a bearish position with a 41% vertical width. That's exactly what you're looking for to take a really nice trade. Now, I'm looking for a 45% vertical width. Now, I'm looking to execute a trade with a 55% vertical width. And I'll tell you right now, I'm looking to take it on a Bitcoin miner. Remember that Bitcoin very soon is going to have the SEC and a whole bunch of other financial institutions make a decision as to whether or not there's going to be an actual Bitcoin ETF. If there is, Bitcoin is going to skyrocket in price, and the miners are going to also fire out of the gate like crazy. There's also going to be something called a halving with Bitcoin that occurs in April. I'm looking to take an April bullish spread with a vertical width of 55%. Now, we could take trades like that. Those are very hard to find, but we would only have to make 45% of our trades profitable in order to trade in the green. So we're going to trade credit spreads that generate not more than a 33%. We're looking for 40 to 45% minimal. If we can get a 50% or 55%, it's unusual. We're looking to optimize these widths on every trade. We're only going to trade liquid symbols. So there's a lot of options churning underneath, and we need the spreads to align with our technical view of our anticipated of the technical direction that we anticipate the underlying to move, whether it's bullish or bearish. But we only have to be right by 1 cent in order for us to get a 100% winner. completely different than when you buy a call, where you need to make this, when you need the underlying to make a significant move to the upside. Now, I think I'm going to skip this slide. Now, here's the XLV. Now, XLV is healthcare. Just so happens this is a sector. Now, XLV is an iShare sector. I love trading the sectors. And you can see it's a bearish call. Look at the direction here. This is a chart off the platform. It's a very rudimentary chart. Doesn't have all the power that the actual right line trading system does, but it certainly projects a direction. And we can look at where resistance is right here. This line I drew is a little tilted. The key is we're looking for a retracement back to resistance and a move down. It's happened every time. A move down, back to resistance, down, back to resistance, down, back to resistance, down, back to resistance, down. Vertical width here is 43%. That's a terrific trade on, and that is the healthcare sector, XLV. Here is on FXH. And I don't even remember what that is, to tell you the truth, except it's giving us a vertical width of 40%. And you can see we've got the same scenario here with our bearish direction, our move back to resistance, and our anticipated continuation to the short side with a really nice, juicy vertical width that mandates that we only win 60% of our trades. Our vertical width here, our premium width is 40%. So the critically important metrics on a credit spread are obviously the direction, whether we're bullish or bearish, the expiration date, which was pretty much fixed, the two arms of the trade. You sell one put, you buy a put, you sell a call. You buy a call, we already know what we're going to be doing. If we're bullish, we're going to sell the 50 delta and we're going to buy the 50 buy the 25 delta put. If we're bearish, we're going to buy the 50 delta call and sell the 25 delta call. Then we're going to get a premium that's going to create a premium width. The premium percentage is what we're going to calculate. It takes about 8 seconds. Now the intrinsic volatility rank is what creates these great spreads with these big juicy vertical widths, which on this particular miner is 55% vertical width. And again, as I'm nearing the end of the presentation, I'm really giving you the formula. You're going to sell the 50 delta, buy the 25 delta. If you're bullish, you're going to do it with puts. If you're bearish, you're going to do it with calls. And you're going to look for a vertical distance between the two strikes. For me, it's got to be between 40% or more. Now, we're going to close the position almost always 7 to 14 days prior to expiration, because we want to avoid what's called gamma whip. And gamma whip is where some unanticipated news comes out on the trade because there's very little time premium left to buffer the trade and very little time to repair a trade. Now, I haven't gone into all the ways that you can repair a credit spread trade that sort of moves a little bit against us. There are many ways that we can do that. But we're going to lose the ability to band-aid the trade, and we're going to get what's called gamma whip, where a small change in the underlying price of the stock makes a big difference in the amount of credit that we're going to get on the trade. So we're going to close the trade within 7 to 14 days of expiration. We do that consistently so that as you're in the service, every week you're going to get paid. And you're going to get paid 4 out of 5 weeks if we continue at our present clip. Now, what I do is really very simple. I look at the best performing sector. Within that sector, I look at the best performing subsector. The time I shot the slide, it was oil services and drillers. And then I'm going to look at the oil service and drilling stocks and see which one has the greatest intrinsic volatility, gives us the juiciest vertical width, and that's going to be what we're going to trade. It's really very simple how it's done. It just takes a lot of time to find the trades, but you're going to know exactly what to look for, because I'm going to do a lot of education in this service. Now, this is what the scanner is going to look like, and you're going to get this projection every Sunday night. You're going to see what are the juiciest trades out there based on the premium width off the scanner. And I'm going to tell you how to get the scanner for free. It's not a right line trading tool, but you can get it for nothing if you want it. I'll tell you it's going to help you a little bit. It isn't really the key to winning. No scanner, believe me, if the scanner was the answer to our hope and prayers, everyone would be rich. It's finding these trades. The scanner can point us in a direction. It's not going to give us the optimal trade, but I'm going to show you how you can get it. If you don't want to get it, you're going to get the scanner results once a week anyway. Now, I just want to show you one other trade we took. It's a closed trade. This is on Vertiv Holdings. Vertiv is in the technology sector. It's an internet networking stock. I sold the December 15 4250s. That was the 50 delta. I bought the December 15 3750. That was the 25 delta. We got a $2 spread on it was a 40% width. We bought back the close. It was only worth 30 cents when we brought it back. We made $170 per spread, which was 85% of the maximal potential reward we could get. Now, the performance, I haven't updated it. Since this time, we've closed 5 additional trades. And of the 5 trades that we took, we had 4 winners and 1 loser. So you can add 5 in the winning column and 1 in the losing column, and we maintain our 85% win rate. And at that clip, we are trading so deeply in the green in a market where most options traders, I'm telling you, are getting eaten alive. I know they like to tell you everyone's making a ton of money, but this is not a forgiving market. Look at yesterday and today. Yesterday, the market took a nosedive. The last time I looked before I started the webinar, it was pretty bullish. It's up, it's down. Now it has an overall bullish trajectory, but we just don't want to settle on taking a trade that's bullish. We want a real juicy vertical width. We want to make a lot of money when we get a winner. Now, I always go to the old adage of those that can do and those that can't do teach. Yeah, you can get this, and I could have recorded I actually recorded one anyway, but I'm going to teach it to you live. We're going to do 4 live trading sessions as part of the package that you get. But I'm going to give you the trades. The flagship newsletter comes out every Sunday night. So this is where I toil away looking for the best trades. And one's coming out on Sunday. We only have 1 open position left in the portfolio, and it's on one that we're deeply in the green on. And I can tell you right now, it's on UTech. And I can tell you the ticker. It's on UPath. I'm sorry. And the ticker is this is the 1 open position we have. We just closed out 5 trades. Bang, bang, bang. For 4 winners and 1 loser. And UPath today was up 51 cents. we are just hanging right below 100% of our net credit. Now here we still have some time left on this trade to evolve. So I believe on UPath, we're going to wind up with 100% of our potential net credit. So I take the trades in my live money portfolio. So it makes a big difference. I just want you to know one thing. When you've got these gurus throwing out trades to you via these alert services, and they don't take the trade themselves, it should tell you something that's really important in your head. It should tell you, well, it's good enough for you to trade and make money, but it isn't good enough for them to trade. I mean, doesn't that tell you something about the trade? If I give you a trade and you challenge me as to whether or not I've taken it as well, I will snapshot my thinkorswim live trading account. The only thing I'll redact is my trading account number, and I will show you that I'm in the trade with you. It's good enough for you to trade and make money. I should be in the trade as well. So I am one of, just like David Weiss, David Kushner, Craig Emery, we all trade live. This is a team that uses the software and the techniques that we teach you, and that we not only take trades, but we take them in our own real money account. That distinguishes Right Line Trading from every other company out there. We risk our own money on the trade because we believe they're ultimately going to evolve into winners. Now, our mandate is to teach. We are not money managers. We're not licensed money managers. But what we're looking to do is to teach you how to trade profitably. Now, what you're going to do, and here's what you're going to get. Now, I put 2 optimized credit spreads, but moving into the end of the year on this market, I'm only going to give you one. One's going to come out on Sunday night, and if you get that, and if you bag and tag that as a 100% winner, I'm telling you, you're going to be extremely happy. When the market settles down after Christmas and New Year's, we'll go back to 2. I'm going to give you every metric on the trade with multiple intra-week updates. Our targets are included. Everything that I do, you do. I get in at the price I tell you. I take the target that I provide to you, and the intraday updates are how I'm looking at the trade as it evolves. You're going to get bi-monthly live credit spread training. It's only going to be for members only. And it's my goal to make you a master at trading these. And I'm telling you, as an educator, this is one of the tools that can make you a lot of money because it is very forgiving. You can be wrong and make money. And there's very few. I can't think of another options formation that provides you with this kind of latitude and leeway on a trade. You can make 50% on a trade that you call totally incorrectly. That's very rare. So here's the offer, and I hope I got the promo codes and everything right. A month is $49 for the first month. You have to use coupon code SAVE $70. $save $70. This is if you'll see, this is a separate color for the new year and for the holiday season. I reduced the price of the year to the lowest price ever, $628. The coupon code is SAVE 55%. And these really are the regular prices. You go to the website, it's $119 per month, and it's $1,396 for the year. And that's the price we're going to charge you if you don't come aboard. Now, I only think you have about 24 hours to close the sale. Rory created a landing page, and that landing page is going to be removed. And when you click on the link, it is not going to be operational at this price. Now, if I can win 85% of my trades, which is my historical record in a live money account, $49 for a month and $628 for a year is a walk in the park. You can make $628 on one winner. If you can move at an 80 to 85% trajectory, you're going to sweep an enormous amount of money off the table. Now, I can't guarantee that we're going to trade at 80 to 85%. I believe we will, because I'm going to be trading this system with my own money. So let me go to any questions. I don't know how I'm running for time here, because I know I got in here a little bit late. But let me just go to any questions if there are. Hey, good afternoon, everyone. How are you? Hold on a minute here. Oh, thank you. Thank you so much. Now, I actually have to see here. Okay, Jim, as I said, a typical trade duration is usually about 30 days. We're looking at a 42-day expiration, but we're not going to hold the trade 42 days. We're going to be holding it about 30. But remember, new trades are going out every week. So after a while, we're going to have expiring positions every single week. And if we continue with our present course, 85 out of 100 trades are going to provide you with a very, very nice premium. How often do you call? You know what? I call a trade usually on the weekends. You're going to get one or two trades on a Sunday. Now, the reason I don't call them intra-week is I have to sit here using my Thinkorswim portfolio and laboriously go over the trades and look at the credit width of every trade. It takes a lot of time. I mean, I have my hit list, and you're going to get the scanner results, and that's a nice place to start. But I build a hit list during the course of the week. And then on Sunday, I just sit here and go up through stock after stock after stock until I find a vertical width that's 45%. I found one that's 55%. Now, it still hasn't executed. It's still an open trade. We need the underlying stock to go down about 7 cents. It's a very cheap stock, but it's a minor, and I believe we're going to get to keep $55 on every $45 of risk. And there's just one more thing I'm going to say, and there's one more question, and that is the key to making this profitable is to take equal risk on every trade. So if you risk $55 on one trade, if you're going to risk 250 per trade, 500 per trade, 1,000 per trade, you're going to take the number of spreads that equals the amount of money that you can, without any sweat, lose on a given trade, understanding that we're going to have multiple open trades at the same time. You have as many as 5 or 6 open. You must do that. And if you do that, then when you have 85% winners, you're going to clear an enormous amount of money. I love the philosophy, do as I do, not as I do. As I said, I really appreciate that, Alnor. And Maria, I really appreciate you for coming aboard, and James. Alonzo, thank you. Thank you, Jeff. I really appreciate. So for everyone, thank you so much for giving me your time. I wish you a really happy holiday, a great new year. I hope you'll be along with me in the service. Trades are coming out on Sunday night. And you're going to see that the performance that I put underneath that last slide is accurate, because all the positions that we've traded are on the newsletter. I keep our track record visible so that you can see how we have done. It's a very transparent service, and I take every trade that I send out. Again, have a happy holiday and have a wonderful, wonderful new year. And thank you so much for giving me your time. Have a great evening, everyone. Bye-bye.